Hello and welcome to Forex.Academy. I am, of course, your host, Robert Blackwell, and have the pleasure to walk you through today's daily education. Before we do so, let us consult the following disclaimer. There is risk involved in trading the financial markets. And we'll proceed with today's lesson then. One of the most common questions I get asked as a trader, of course, and trading with technical analysis is, where exactly do I look for fib levels in the market? How do I place my Fibonacci retracement? And how do I actually trade the signal itself? So what I'd like to do is just to walk through a few examples trading the Fibonacci retracement across various Forex markets. So I'll just jump on to our preferred broker, of course, JFX, and we'll trade some markets here. What we have here in front is the daily price action of the US oil market, or the WTI oil market. Okay, so how we look to trade a Fibonacci retracement is to actually trade with the trend, of course. If in fact you're looking to look for the reverse signal, you can do that, and I will explain that as well. In terms of inputting the Fibonacci retracement onto your trading platform, there are two methods to do so. So you can go to insert here Fibonacci retracement, or of course you have a signal just here in the market that draw Fibonacci retracement line, and you can simply select it there. So you have your little icon here that you can move across the market. What you're looking to do is follow momentum. So we have an overall trend to the upside in this bullish oil market now from around the $57 market. The first thing we'll do is look at the last corrective low. That is our price point, okay? That is our swing low, and we'll pick that price point by clicking and holding our Fibonacci retracement, and we'll drag that to a relative swing high, again, so to the top of the move. So this is what we are privy to at this point in time. If we consult the price action itself, when we are perhaps in this candlestick period here, we know, well, the market has pulled back. Okay, so that is effectively the time that we can point our point B, which is effectively the swing high. So we have our point A below. Effectively, we are looking to trade this market to the upside. So what we're looking to do is find the best risk reward possible trade for us in terms of following momentum. Okay, so as we see, the market trades up, it actually trades right down to our 23.6 retracement level, continues past our 38.2 retracement level, actually continues past our 50% retracement level, and we actually get the best trade-off in this particular instance. Why is that? Well, because these collectively are known as our retracement levels here, are 0 to 61.8, and if the market decides to pull back the whole way to the best risk reward on the trade, that can give us the best potential for upside in terms of following momentum. Again, the reason why we define it as technical analysts as a retracement is because it's pulling back to the ongoing trend in the market. So we're looking to trade the trend itself, but we're looking for a better price to trade that trend with. So evidently this market here, the oil market, pulls back to our 61.8 retracement level. We get a buy signal here at our level. If the market trades and closes below this level and closes around here, well, then effectively the Fibonacci retracement signal is invalid. Okay, so we can X that out at a given point of time. So what I'll do is just go through some more annotation here. We have our trade to the downside based off our top high at level B. From swing high to swing low, we move it from A to B, of course. We get the trend to the downside, providing us with the best risk reward at our 61.8% retracement level. And we get two candlesticks that confirms that that decision is correct to follow the trend to the upside. Evidently, we get a bounce from 1, 2, 3 Fibonacci levels. So we get the trade up to our 23.6 retracement. So it's still a good winner if we're trying to capture the move to the upside again. Again, it's not conforming to the overall trend, unfortunately. This time, it does reverse off the 23.1 signal. And again, we're not sure in terms of where this market structure is going to go. In the long term, however, it most certainly does conform to the best risk reward trade on this, the 61.8% retracement level. So if we see this price action right here, we can see that the descending triangle, there's no continued break to the downside. The Fibonacci signal is still valid, so that's a tick for us. Then we look to move momentum to the upside. Perhaps a buy of this level here And again, I'll just change the color of my pen to denote this. A buy of this level here could perhaps present the best trading opportunity. We could then put our stop loss below the corrective level. So if it's a long-term trend, guys, we are looking to trade this for long-term price objectives to the upside. You can see how we can use the Fibonacci retracement as our stop loss as well, because more specifically, if the Fibonacci retracement breaks down, i.e. it breaches and closes way below the 61.8% level, our signal is now invalid from high to low. So A and B is now invalid and is not tradable. That is not the case on this particular market. We get our buy signal again. I'll just highlight the candlestick there. This candlestick gives us our buy signal with best risk reward from the Fibonacci retracement, again from the 61% level, and we get continued movement to the upside. So again, we're looking to follow that momentum, and again, we can actually look to capture profit above and beyond the full retracement from our zero level. So that's a fantastic trade simply by using the Fibonacci retracement level. What we can then consult is the new or more relative price action. So what we'll do is simply look to move our Fibonacci retracement. So as this market trades to the downside again, we see this as the new corrective high in the market. We move the Fibonacci retracement again to the last corrective low, which would be the swing low again, perhaps this one. Now we have yet another new Fibonacci retracement. We look to trade from swing high, relative swing high to relative swing low. And again, we are looking for the best risk reward ratios, given that markets, well, they tend to trend like this. They certainly don't trend in a very linear fashion. So effectively what happens in this trade, then again, we see the market move down to the downside. It does bounce off the 38.2, but doesn't give us continued momentum to the upside here. So that's unfortunate. We see a strong move to the downside again with a lot of volatility. Again, where is the volatility? It's in our price range of our 50 to 61.8% retracement level. We get a worrying signal with this candlestick that the price is going to continue, but again, the price trades up quite strongly the next day and creates a new high just above our 50% level. What we could do then as traders again is simply construct and formulate a trading strategy here. This is our relative new low. This is our relative new high. We're looking to follow price to the upside. Again, this is our signal that the price will not break the level, and the next day it does not do that. This could be our buy signal just above our 50% level again, and we are looking to follow momentum to the upside. That is as simple as that, with the best risk reward at the 61.8 retracement level. So I hope that gives you some insight into following swing highs and swing lows with Fibonacci retracement levels. I do hope you enjoyed it, and I hope you learn to use Fibonacci retracements much more effectively in the markets, because they do work quite well in certain markets, particularly the gold market over long-term trends, the oil market, and many forex pairs as well. So that brings us to the end of this daily education. I do hope you enjoyed it. Thank you very much for joining us here at Forex Academy. I'm your host, Robert Blackwell. We'll see you next time. Bye for now.